Mr. Sulabh Jajaria, Portfolio Manager of Indian Equities at Nippon Life India Asset Management. Mr. Ankit Sanchetti, Investment Manager at Kotak International. And Ms. Sarah Lian, Senior Product Specialist at Allianz Global Investors. A big round of applause, please. This will definitely be another interesting session as we will be seeking the new wave of alpha in India and in China. All right, so let's begin with a look at China. So I'll begin with Sarah. China equities have been a disappointment for several years, but other markets in broader Asia, emerging markets, and Europe have also considerably lagged the US markets. So should investors even bother with China? And what are the merits of taking on China equity risk in your portfolio?
Hi, everyone. Good morning. Thank you for the question. I'm Sarah Lian from Allianz Global Investors, and I'm here to talk about China. I was here last year talking about China as well, and if you can remember, the things we were discussing were things like China's prolonged property downturn, or China's consumer weakness, or China's real wage growth pressures, or China's local government debt defaults, and a lot of very negative things like that. So I think underlying those topics was really a question of, is China even investable? And I'll show you a chart here, because I think this is really why people were asking those questions. And what you can see here is this is a 15-year history, is that the light blue line at the top is the S&P 500, and the dark blue line at the bottom is China, all shares, A shares and H shares. And you can see here also Europe in yellow, and I've got emerging markets in green, and those asset classes didn't do so hot either compared to US equities, but generally speaking, China has been a disappointment for 15 years. And given the title of this presentation today, which is off the menu choices, my interpretation of that is that we're asking the exact same question: should I even bother looking at China when we're dealing with a picture like this? So, you know, what does off the menu mean? Well, to me that means, you know, no restaurant really wants to serve you any China. If, you know, they don't want customers that are going to complain or send it back, oh, this is not what I ordered, this is not what I asked for. So if you had walked out of my presentation last year and bought China equities, that would have been a pretty contrarian thing to do. But actually, that would have been a really smart thing to do, because this is what's happened over the last year. And I don't think enough people are really paying attention to this dynamic, because the China markets, China equity markets, are up 30% in the last year. So, you know, if you ask me today, is China off the menu? I would say no. I think China should be on the menu. It doesn't have to be your main course, but maybe have some China for dessert, perhaps. I know in Thailand, you're all pros at dessert. That's a real, the art of dessert has been mastered here. So I think there's certainly room for China in portfolios today.
What is actually driving this push? Because we know that there are a lot of issues unresolved, from the trade tensions, you know, supply chain shifts, and things like that. So why is the market recovering, and will this recovery be sustainable?
Yeah, so we've had a really sharp V-shaped recovery. Will this go on? I think one of the key messages I want to share is that policy makes a huge difference in China, and we've seen policy support. Some of my colleagues earlier this morning have talked a bit about the stimulus measures in China, whether it's, you know, consumer goods trade-ins, whether it's interest rate cuts, mortgage rate relaxation. You know, there have been incremental stimulus policies. It hasn't been super overwhelming, or super bazooka style is the term that's often thrown out, but incrementally the measures have been positive. The second thing, also, you know, mentioned earlier too, is the DeepSeek moment. I think the world was really surprised that China is competing at that level in technology, that China's far more advanced in AI technologies than anyone had given it credit for. And we think that that's a real message to the world that China is indeed a contender. The other thing I want to point out is, this is the first year in about 3 years where we've seen private enterprise performing better than state-owned enterprises in China. And a lot of this can stem back to the symposium earlier this year where Alibaba's Jack Ma was featured in public at a tech symposium. Private enterprise is critical to China's recovery, and we've seen this come back into the spotlight. And so a lot of these measures are driving the market, are sending us a sign that this is a more sustainable upturn. And we think that with the support for equities from the government in terms of ETF purchases, we've seen $100 billion of mainland Chinese money. This is a big number, right? Flowing from mainland China into Hong Kong. So the Hong Kong market is up even more. You can see here in the dark blue line is the H-share market. The green line is the China A-share onshore. And you can see China's been one of the best performing markets this year, better than Europe, better than the S&P 500, better than Japan. So we think that there's some really, really encouraging signs of a stabilization in the market from here.
All right, now obviously China wants to be the world superpower, but on the market side, where do you see China's leadership shining through? In other words, where does the opportunities lie in?
Yeah, so I'm gonna skip this. I want to focus on innovation. I know this too has also been mentioned, and maybe put some numbers around what's going on in China. There's often an image that China is the world's greatest imitator, that China can take a technology from elsewhere and scale up really quickly and go from concept to production very rapidly and testing and so forth, and that's very true. China's very scalable, has a large labor force, but our view is that China is becoming an original content creator, and you can see this. It's the largest EV market, it's the largest industrial robots market, it's the leader in advanced driver assistance programs or autonomous vehicles. It dominates in solar production. It's crushing in the biotech space and having extending licensing deals to global partners everywhere. And finally, China has more patents than anywhere else in the AI space. In fact, 40% of young graduates in China are graduating with a degree in a STEM area. This is more than India. India, that number's more like 30%. The US, that number's more like 20%. So this is not something that happens overnight. China has been ramping up for a long time, and we think that these are really promising areas. And I also want to just show one last thing just on trade, because obviously that's very topical. But I think there's a little bit too much emphasis on this trade argument. And what I want to show here is if you focus on that sort of light blue, which is the US, China's trade with the US has been going down for a long time. This is not something new. But what's really interesting is where that trade is going, because Chinese exports are actually growing, and they're growing to Southeast Asia, they're growing to LATAM, they're growing to Africa. So there are many, many countries that are willing to trade with China, and especially when China has all of these products that are so innovative and so important, especially in the healthcare sphere where they have drugs that are saving people's lives. China is very much open for business.
So the growth story in China is pretty strong. But then again, if we look at India, it has been performing better than the Chinese equity market. So people compare these two stock markets. So in that sense, is it a good idea to switch from China to India?
Well, I'll let my colleagues here speak more about India, but I really think that's the wrong question to be asking. I mean, we don't see it as a choice between China and India, because I think both markets are very different. It's not apples to apples. What you're seeing, I mean, I've given you a lot of examples in the tech space in China.
Yeah, thank you. Thanks for this question. So in India's perspective, if you see, a lot of things have gone right over last 3 to 4 months. First is on the fiscal front, India in the past had been tightening for a while. Recently in February, Indian government did a personal income tax cut, which obviously gives around $11 billion into the hand of people to spend. Secondly, on the monetary side, where a lot of countries are going slow in terms of rate cut, Indian Central Bank has done 100 basis points of cut over last 6 months. In addition to that, they have infused more liquidity in form of cash reserve ratio cut by 100 basis points. So a lot of liquidity is getting into the system, money into the hands of people, which obviously helps eventually in consumption. Additionally, I think the other challenge in India over last 1 year was earnings growth, which has been lagging. The mid-teens kind of earnings growth came down to 5 to 6%. Now with this quarter, which is being reported and going forward for next 1 year, we're expecting the earnings growth to come back to teens to mid-teens kind of level. So that obviously helps in getting the investor interest back into the market. And as a result, a lot of foreign investors who were selling in the Indian market, March this year onwards have started buying back into the Indian market. So I think domestic investors, as it is, have been investing heavily into the Indian market. I mean, $3 to $4 billion of money coming every month. But foreign investors was a bit of a concern few months back, which has also turned around. From the government angle, also the other part is the capex from the government side has been recovering now, because last year being an election year, things slowed down from the government side. And if we talk between urban and rural, urban is yet to recover in consumption, rural has started already recovering. So overall, if we put together all this, despite whatever is happening globally, whatever we hear around, India can still deliver 6.5% of GDP growth on the base it has. So we think it's an interesting area for people to look, invest in, and we think, I mean, it's a long way to go, as my colleague here was saying that China is like maybe 20 years ahead of India. India is where China was in early 90s. So we believe it's not a story for 1 or 2 years, but maybe next couple of decades to go from here.
I see. Now, with these facts that you provided, there are still some global risks ongoing, the trade tension and supply chain shifts out there. So what's the current situation on the Trump tariffs in India, and how is India exposed to these risks?
Yeah. So obviously, this is a lot of noise around tariffs, and you hear things changing every day. Every morning when you wake up and you read the news and things have changed overnight. So I think from India's perspective, they've started the negotiations in February of this year on the trade deal front. And our ministers and their ministers have been doing rounds of both New Delhi and Washington to discuss this deal. There was some kind of an expectation of finalization of a mini deal by this week, but which didn't happen. But what we've heard from the various news articles is that by September, we should get a final trade deal between India and US. I think a couple of areas where this is getting stuck up is mainly agriculture, because India's farmers are a big community. They're a big vote bank for the government, and they want to protect them. So that's where I think things are getting stuck up. But by September, you should see something coming out. And also, they have mentioned that even on the 1st of August, when the tariffs kick in for the other countries, India might have a special situation in that case in the tariff coming in. So I think we are not
How special?
Sorry?
How special? What do you mean?
So they haven't mentioned the numbers, but it might be lower than what Japan has got as of now. That's what they mentioned in the news articles. Yeah. But eventually, it should, eventual plan is that current India's trade with US is $130 billion, which they want to get it up to $500 billion by 2030. So whatever happens, we believe it will be good for the benefit of trade. And along with US, I think the other good news is yesterday, we also signed an FTA with UK. Right. And current discussions are going on with other countries like Peru and Chile also to sign trade deals. So we believe this whole adversity of tariff is going to become an opportunity for India's trade over the next 5 to 10 years.
Now, with the deal signed with the UK recently, how major is this milestone, in your sense, in your views?
No, so I think it's a very interesting deal because UK and along with that Europe are big trading partners with India. And this deal discussion has been going on for almost more than 2 to 5 years. So we think the culmination of this really signifies a lot for both the countries. in terms of opportunities and ease of people even moving across the borders between the two countries. So I mean, definitely something which excites us and UK also from that perspective.
Now let's take a look a bit on the mega trends that is shaping your growth story. We hear things from the healthcare sector, manufacturing, finance, consumption. Which of these themes are compelling and best positioned to deliver alphas that we're looking for?
Sure. So I mean, India, of course, has a big population now. I think it's even surpassed China with 1.4 billion people. So consumption is definitely a very major theme because India has hit the $2,500 per capita GDP, and that's the same number at which the J curve happened in China in 1990s and Japan in early 80s. So we think that opportunity is there in terms of consumption. Then if you come to manufacturing, of course, China has been the manufacturing factory for the world, and that is where India has lagged. India has done very well in terms of services. So manufacturing is the other area, especially in the field of electronics, chemicals, pharmaceuticals, auto parts. So all these areas are being encouraged by the government. They are giving incentives to people to start manufacturing in these areas. And obviously, you start very small. In electronics, China is very big, Taiwan is very big. India is just a new kid on the block in terms of electronics manufacturing. So they start with basic component assembly, then they are going to build PCBs, chips, and then eventually do fab units also. So I think a lot of work is happening on the manufacturing front. Then even healthcare is a very interesting area. Again, with a big population, domestic healthcare market is big. It's growing at 10 to 12% every year. And along with that, India is a factory to global pharmaceuticals also. So I mean, to give you a number, India supplies 40% of US generics by volume. So a big exporter of drugs. Even during COVID, it was a big supplier of both vaccines as well as drugs globally. So we think that is an opportunity from a healthcare perspective. And the second one is hospitals. So as we know, even Thailand is very popular for the regional people coming down to Thailand getting the quality healthcare. Similarly, India has a big domestic market for healthcare because the population is big, the availability of hospital bed is much lower than that population to work on. So next 10 to 20 years, you can see 15-20% growth happening on the healthcare hospital side in India. And also 10% of their top line also comes from foreigners who visit India for quality healthcare because it is one of the cheapest quality healthcare in the region. So healthcare is the other interesting area. So I think all these put together offer a lot of opportunities for people and for people like us to run funds and invest into Indian themes. Yeah.
Now let me go over to Mr. Ankit from Kotak International that has built a deep research in the mid and small cap space. Can you share your thoughts with us, if India offers a sizable and investable universe in the mid and small cap segment?
Sure. If I look at from an India perspective, the Indian capital markets have both broadened and deepened in the last decade or so, both from its own historical trajectory and also from a perspective, from a global peers perspective. So if I look at globally, India now stands at the fourth position in terms of number of stocks with market cap of more than $1 billion. So there are more than 600 odd stocks today, which has a market cap of $1 billion plus in India. And at that position, India is number 4. If I look at India from its own trajectory, in the last 6 odd years, since 2019 till 2025 as of today, and if I bucket the stocks in, say, $1 billion, $5 billion, $10 billion, or $50 billion bucket categories, even in all individual categories, the number of stocks have either doubled or tripled. So just to give you an example again here, if you look at number of stocks with more than $5 billion market caps, in 2019, there were 82 stocks, which were having a market cap of $5 billion or more. As of today, that count is 212 odd stocks. So clearly, in the last 5-7 odd years, the Indian capital markets have broadened, which gives more opportunity for investors like us to invest in the mid-market space. And from a deepening perspective, If I look at from a liquidity perspective, here again also, if I look at average daily turnover volume of stocks with more than $10 million, there are more than 300 stocks with an average daily turnover volume of more than $10 million. So clearly, if I look at in the last 5 to 7 odd years, the Indian capital market has both broadened and deepened.
So the universe is really big. But when we talk about mid-caps in India, what makes it unique compared to developed markets? Why is it interesting?
Sure. So that's a very valid question, and that's a question which most of the investor keeps on asking to us. And for a very long time, we have been a very firm believer of mid-market segments in India. And while if I look at from a global perspective or from a emerging market country like India perspective, mid-markets investing have a certain characteristics which is very common. What are those common characteristics? Mid-cap companies typically demonstrate a high earnings growth rate. There is a limited ownership from an institutional investor perspective. There is also a lower analyst coverage, and typically mid-market companies have higher volatility. So all these traits, characteristics are again common when you are investing in mid-market in India. But what make India mid-market investing very unique is first and foremost, as I mentioned previously, the diversity of sector which is available in India from a mid-cap space is very unique. If you look at most of the other emerging market, even if you look at the US market, the capital market is dominated by large cap companies. That's not the case in India. There is a diverse set of sectors where mid-market companies are present, and that gives an opportunity to investor, or it gives a rich canvas of opportunity to investor to create a portfolio beyond the tier 1 companies. So that's the first point. If I look at from a second point perspective, over the last decade or so, lot of foreign investors are encouraged by India's GDP growth rate. Sulabh pointed out that sustainable GDP growth rate of India can be somewhere around 6.5%. In real terms, in nominal terms, we are talking about 10 to 11% of nominal GDP growth rates. And we believe that for the best way to capture that domestic growth story is through investing in mid-market companies, because mid-market companies' businesses are more oriented towards the domestic variables, and that is why they are better proxy to the domestic growth story. Third, and the most important point here, is that unlike emerging market or unlike developed market, where mid-market companies might be fringe player within their categories, in India, there are multiple sectors where mid-market companies are either sectoral leaders or they have a very dominant second position in that category. I can give you some examples which is there on the slide also. If you look at the largest hospital chain company in India, largest hotel chain company in India, largest tile company in India, largest plywood company in India, QSR company in India, apparel company in India, footwear company in India, and so on. Across all categories, mid-cap companies are sectoral leaders. So they are not fringe player, they are not the 6th, 7th, or 8th company within the sectors in which they are operating, which typically is the case when you are investing outside of India. And finally, if I look at from an India, it is the 3rd largest startup ecosystem in this world. And many of these companies are now getting listed in the public market. And if not all, almost all of them are getting listed in the mid-cap space. And that is another opportunity for investor to invest into forward-looking, tech-driven companies in the mid-cap space. So if I look at in holistic view, I think mid-cap is a very unique positioning from an India perspective. Not only it gives you domestic story, but it also gives you a diversity, and also you are buying companies which have a very dominant position.
But then again, in a space which is really broad and dynamic in this segment, some companies might not be well known or well tracked. So how do you assess corporate governance? Because that can be an issue.
Okay, so again, again a very fine point that corporate governance is again a pushback which comes very frequently when we pitch mid-market companies to global investors. But here again, the canvas has changed in the last decade or so. There are 3 broad dynamics which have come into play. Clearly, the key driving force has been on the regulatory side. The second has been the investor activism. And third has been the transparency, which is typically the technology-led transparency, which we are seeing in the system. So if I look at from a regulatory perspective, SEBI, which is the capital market regulator in India, through their listing obligation and disclosure norms, have come out with lot of mandatory disclosures and policies which needs to be followed by the companies. Say, for example, there are certain numbers of minimum independent directors which needs to be there from a board composition. There are a number of women directors mandatorily which needs to be there on the board. There are audit committee independence related regulations. There are code of conducts and so on. So there are a lot of regulatory changes which has been implemented and which has improved the corporate governance for mid-cap companies. Beyond that, investors like foreign institutional investor and mutual fund domestic investors have also now required to vote on all the resolutions which are put forward for shareholders. And in many of those resolutions, even players like us, we have blocked some of those resolutions which has questionable either related party transactions or where we thought that the remunerations was not commensurate or it was too high versus what the delivery of the management has been. And finally, I think a lot of mid-market companies particularly are now voluntarily adopting to ESG regulations, and that is also helping in terms from a corporate governance perspective. If I look at again from a summary perspective, I will say that mid-market corporates have realized that a better corporate governed company typically gets better valuation premium. They are more covered by analysts, and multiple times, they are also getting included in various indices. So it also helps in wealth creation at the individual promoter level also.
Now, for those companies who pass your quality and governance filters, how do you identify that companies will scale sustainability into being a large cap?
Sure. So let me walk you through the investment philosophy, the core investment philosophy which follow. At Kotak, it's a bottom-up, fundamental-driven, research-driven focus in terms of identifying companies. We are looking at companies which not only have a competitive advantage or competitive edge versus the competing companies in the same industry, but we are also looking at companies which can provide sustainable, scalable growth rates. We are focused on companies which have better corporate governance. We measure the companies in terms of their capital efficiencies, in terms of their execution track record. And when it comes from a valuation perspective, moving beyond the price to earning, price to book multiples, we are very focused on free cash flow generations of underlying companies. We are looking at return on equity capital, return on incremental capital deployed, and so on. So that's the context in which we go about investing and identifying companies. And let me illustrate two examples to see how this philosophy is put into real action. There is one company, Britannia Industry, which is there on the left-hand side. It is one of the leading fast food packaged company in India. It is, when we invested in 2011, the market cap of that company was around $1 billion. In 2013, there was a change in management. Mr. Varun Berry, with a very strong credential, he was an ex-Hindustan Unilever, ex-PepsiCo. He joined, and there was a pivot in the strategy of the company. From a predominantly south and east focused company, they started to make inroads, set up more distribution network, invest more on the marketing network, and try to capture into the northern and in the western parts of India. Beyond that, over a period of time under his leadership, we have seen they increasing the addressable opportunity for themselves. So beyond the plain glucose biscuits, they moved on to cookies, they moved on to cheese, butter, dairy, and other products. They started exporting some of these products outside of India. They have exports now spanning beyond now 60, 65 countries. So over a decade of our investment in this company, if I look at from 2011 till 2020, that's the time when we exited, not only the earnings CAGR for that 10-year period on the revenue terms was 11%. In terms of EBITDA, it was at 26% CAGR, and in terms of profit after tax, it was a 30% CAGR over the last decade. And from a return perspective, when we invested, it was $1 billion market cap. When we exited in 2020, December of 2020, we exited at a $12 billion market cap. So 12 times return in close to 9 to 10 odd years. Similar is the case with some other companies like SRF. Again, it's a chemical company. We see a transition happening from a pure technical textile company to entering into specialty chemical. They successfully, by investing into research and development, focusing incrementally from a capex perspective. And one interesting point, I think, which he mentioned was from a China perspective. Yes, China is very ingrained in the supply chain, but in the last 5 to 7 odd years, India is now catching up and trying to integrate itself into the global supply chain, in which companies like SRF, which is a chemical company, they have set up relationship with lot of global agrochemical companies, likes of Bayer, likes of Syngenta, likes of Adama, FMC, and so on. And again here, when we invested in that company, 2016-17, it was a sub-billion-dollar market cap. We still continue to hold that company in our portfolio. The current market cap is, again, close to $11 billion. So in last probably 8 odd years, again, the market cap has more than 10 times. So that's how we are going to invest in these companies.
So it's become a very attractive segment. Now let's take a look at some of the concerns. Let me go back to China. And Sarah, we have the ongoing China-US trade tension. Would you like to share your thoughts on this matter and how will it affect the outlook in China as we go forward?
Yeah, I mean, I think this is not a new issue. China's been dealing with Trump since his first presidency. The real thematic here, from an investment standpoint, I think is this self-sufficiency angle. China has been, for the better part of a decade now, ramping up its self-sufficiency. And a lot of the emphasis has been on the technology space, and because of all of the restrictions on for example, high-spec chips going into China from the US. But actually, it's a lot bigger than that. I mean, if you look at like food security, if you look at energy security, if you look at military security, there's a lot of other angles to self-sufficiency in China, and China doesn't want to be beholden to any other nation necessarily, whether it's the US or elsewhere, and has been very effective in using its talent and resources to develop domestically. So from an investment standpoint, those are where we see the real opportunities, and there's many ways to play China that don't have an export angle at all, in fact. So yeah, I think this is something that's not going to go away overnight, and it's something we're going to be talking about for the days to come, but I don't think it's the main event, and I don't think it's going to massively derail the good things happening on the ground in China right now.
Now, if we do enter a lower rate environment globally, how will that reset the opportunities for China and for the broader Asia?
Yeah, I mean, I think China's already in a pretty low rate environment. So I think from a global perspective, for example, I think the big swing factor would be the U.S. Fed and lower rates in the U.S. and a weaker dollar. So obviously, for China, for emerging markets, a weaker U.S. dollar is a huge tailwind. So that would be actually quite beneficial for China.
Now let's get back to India. Any downside risks that we need to watch out for, especially when stocks are trading at high valuation multiples? How are you managing the risks? Sulabh?
Okay. Yeah, so risk, of course, are there in any kind of investments, and that's true with India also. So I believe there are two parts, two risks which are there, maybe one domestic and one from a foreign perspective. Domestic risk, I think the most important thing to track in India is the earnings growth. And that is where is the concern, and that is where is the opportunity. Because any faltering in earnings with these kind of valuations will definitely challenge the returns in Indian market. So I think that we should, going forward 1 year, we should just look out for earnings, and if earnings growth comes back to the mid-teens kind of levels, you should be able to make good returns and compound your wealth in India. That is one part. The other part, the other risk which lies is more from a foreign perspective. with global geopolitical issues and of course tariff, which we had discussed earlier, which to me seems a lesser risk, but the geopolitical issues are a bigger risk for India. So India definitely is a big importer of crude oil. 70% of its crude oil is imported. So any kind of a tension in the Middle East, which was happening, the crude oil prices go up, which does impact India's foreign exchange outflow, India's fiscal deficit. And also if India is a big importer of cheap Russian crude. So if anything happens on that front where a big tariff is imposed by US on India and China from a Russia's perspective, that can be a challenge for India from a crude perspective. However, having said that, the interesting part on the other side is Mr. Trump wants the crude prices to remain low. So this is a bit of an anomaly that what happens with Russia and what happens with the crude prices. So it's a very complex situation, but yeah, these are the two things I can think of in the current context.
Just if I would want to add something and put slight context to things, and one very big pushback by every investor is that India's valuations are at a higher end, not only relative to their own historical past, but also relative to, say, other emerging market or even developed market like US. And I believe fundamentally there are valid reasons why the valuations are at the level what they are. Clearly, the key reason why investors are investing into markets and typically in emerging market like India is because of its growth differential. Not only growth differential as of now, but the sustainability of that growth differential over the next decade. India is a young population. We are a democratic country. I think it's a long runway of growth which is available, and at a macro level, both on a current account, fiscal deficit, India has traveled a very good distance. So macro remains very positive. And if I go back to one of the panel previously, they were talking about Japan ROEs now going back to 9%. India's companies' ROEs are mid to high teens. Some of the mid-cap companies' ROEs are close to 25 to 30%. If companies are able to deliver mid to high teen earnings growth rate with such high ROEs, it's very, very difficult to find them at cheap valuation. India is traded cheap only when there is a Six Sigma event, so one needs to wait for another COVID. I don't think another COVID is going to happen. I pray it doesn't happen, but it has to be a Six Sigma event for India to become cheap. Otherwise, getting India cheap, waiting for it will be a long haul. And then there is a technical aspect to it. I think the flows in the domestic mutual fund industries are so overarching in India today. And again, we believe it's a very long-term phenomena, which will restrict the fall, the size of the fall, and also the time of the fall. If I go back to the recent past where because of geopolitical issues, Trump tariff and so on, the Indian markets have fallen, but their propensity to bounce back much faster is mainly because of the flows by the domestic investors. So that's what I wanted to add what Sulabh was.
Now, if you were to advise investors into the time of entry into the Indian market, because waiting could be a long haul, as you mentioned, so what would be the best time of entry this year?
So the best time to invest is
today.
Absolutely, right now. Again, I have been urging investors that when they are looking at India, typically they need to keep India as a part of a core holding, and they have to be invested in India for a slightly medium to longer term perspective. Again, people don't comprehend the perspective that when we talk about companies compounding earnings by 25%, we are actually looking at earnings doubling in 3 years. And it is not that they are compounding only for 3 years. We have seen earnings compounding at 25% for 6 year, 8 year, 9 year, 10 years also. So people are unable to comprehend. They are too focused on near-term valuation. I think the story is longer term, and that's what we believe that the right time to invest is today, and
today,
if it
right
was
now,
not yesterday.
Over lunch, we'll go there outside at our partner's booth. And we have a couple of seconds, let's say about a minute, since the topic suggests. Let me end with this question. Are there any off-the-menu calls that you are excited about now? Sarah?
Yeah, I mean, China equities in general, they've been kind of forgotten about. A lot of, it feels like we've kind of found a floor to the market. We've seen some stabilization. Everyone's so focused on the negatives, but actually there's a lot of green shoots in the market, and we think that this is the right opportunity. I don't want to sit here and be like a super bull and shoot the lights out kind of pitch, because generally, China is in a more mature cycle now, and the world has become more complicated. But we do think there's plenty of opportunities to make money in China, and the key is to be active and be selective and find those unique opportunities.
Sulabh, would you like to say anything else? Your belief in off-the-menu calls for now?
No, so I think
Last shot.
I think the same thing as Ankit has echoed is the time to invest in India for sure, and the opportunity is there for long-term and short-term gyrations will be there because volatility is a part and parcel of investing. But with the domestic flows being strong and foreign flows coming back into the Indian market, I think it's a very good time to start investing, and even the earnings growth is bouncing back. So India definitely should be a part of the main menu.
All right. Okay, ladies and gentlemen, that's it for today's discussion on this topic. A big round of applause, please, to thank our speakers, Sarah, Ankit, and Sulabh. Thanks for sharing your insights with us, China's evolving story and India's growth momentum. So thank you, and now it's time for you to enjoy lunch.